Hi, I'm Matt Jenkins, and I'm the Chief Operations Officer and General Manager for our personal loan business at Opportune. I have the pleasure of leading our thousands of dedicated operations and business team members in our retail stores and service centers in making sure we're meeting the needs of our customers each and every day. I joined Opportune a little less than 5 years ago after 17 great years at Citi, leading operations in the global consumer business, and have been in the financial service industry for more than 20 years. I chose to join Opportune because of its mission of empowering consumers who have been left out of the financial mainstream or have been ignored by traditional banks. Opportune was created to serve the millions of hardworking people who are effectively denied access to the financial mainstream because they don't have a credit score or they have too thin of a credit history to be accurately scored. Beyond the ability to borrow, not having a credit score can exclude you from certain jobs and limit the places you can live because employers and landlords often check your credit score. When it comes to borrowing, people without a credit score and those who have been misscored due to a lack of credit history are frequently among the 1/4 of US consumers who report not being able to cover an unexpected $400 expense. Whether because of an emergency or new opportunity, when these consumers need credit, their exclusion from financial mainstream frequently causes millions of people to turn to alternative lenders, like payday lenders, who do not check credit scores. The trade-off is that many of these loans will cost consumers more in interest and fees, sometimes much, much more than their original loan balance. In 2020, US households spent an estimated $128 billion in interest and fees on just 4 products, Financial Health Network, or FHN, compared to Opportune in this true cost of loan analysis, which included credit cards, installment loans, payday, and rent-to-own. Households who are financially struggling disproportionately pay these costs. Lowering the overall cost of borrowing is an important step in supporting the financial health of low and moderate income borrowers who have limited access to affordable credit. However, while there's a significant demand for small dollar lending, there's also a significant need because of the lack of responsible, affordable small dollar lending. Perhaps this is because the Federal Reserve has repeatedly found that small dollar loans must at least be $2,141 to break even at APRs of 36% and lower. Opportune does not share this view. In fact, we are proof that small dollar loans can be made sustainably at APRs below 36%. And by reporting our loans to credit bureaus, we also help our customers build a credit score, something many alternative lenders do not do. We also believe it is a moral imperative to decrease the cost of credit that is available to LMI communities. There's absolutely no good reason why any loan should cost you more than you originally borrowed. Opportune commissioned this report from Financial Health Network, FHN, on the total cost of loan to demonstrate the value we, at Opportune, offer our borrowers and highlight the fact that small dollar lending can be done responsibly and affordably at scale. Triple-digit interest rates are not aligned with consumers' financial health, nor are they necessary in building a sustainable lending business in the communities we serve. As expected, the FHN report found that competitor products consistently cost more than Opportune loan of equal size. In fact, they were on average 6 times more expensive, and in some cases, as much as 24 times as expensive. How can this be true? Let me share with you a couple of examples. Consider Diana, who lives with her partner and their daughter. Their annual household income is $37,500, and neither adult has a viable credit file. Diana's daughter's laptop just broke and she needs a new one for high school. Cash is tight. And as a study from FHN shows, Diana has some options. Let's consider 2 of them. Diana can either take out a $500 payday loan from an online lender that doesn't require a credit check. In this scenario, Diana agrees to pay $23 per 100 borrowed for a 2-week term. At the end of the term, Diana is only able to pay $48 back of the loan balance after almost $118 in interest owed and feed interest over the first 2 weeks. The rest of her paycheck goes towards housing and food, things that she needs. Her loan automatically rolls over another 2 weeks. Every payday, Diana rolls over the loan again, unable to pay off her balance. After 8 rollovers, Diana has paid more than $1,000 in fees and interest and defaults on her loan. Or she can take out a $500 Opportune installment loan, which does not require a credit score to apply. In this scenario, Diana agrees to an annual percentage rate of 35.95% for a term of 12 months. Diana makes a $22 payment every 2 weeks, and at the end of the loan term, Diana has only paid $102 in fees and interest on her loan. To get a view on a high dollar loan, consider Brad and Paula, who have an annual household income of $65,000. Neither Brad nor Paula have a viable credit score. Their 9-year-old son, Alex, falls ill with an appendicitis and needs an emergency surgery. The family has health insurance, but they are still responsible for out-of-pocket costs of $3,500 for Alex's hospital stay. To cover the bill, they can take out a $3,500 installment loan from an online lender that doesn't require a credit check. In this scenario, they agreed to an APR of 164% over a repayment term of 22 months. Every month, they make a payment of $508, and at the end of the loan term, Brad and Paula have paid nearly $7,800 in interest on that loan. Or take out a $3,500 Opportune installment loan. In this scenario, using proprietary underwriting data and scoring, Opportune is able to offer an APR of 34.55% for a term of 30 months. They make payments of $84 every 2 weeks, and at the end of that loan term, Brad and Paula have paid $1,644 in interest and fees on their loan, or more than $6,000 less than the alternative. So how is Opportune able to do what the Federal Reserve argues is not possible? Simple answer is data and technology. Over the course of our 15 years of lending, we have built and refined sophisticated artificial intelligence models along with billions of data points that allow us to make affirmative credit decisions at reasonable interest rates, where others have been either unable or unwilling to make responsible loans. In addition, we have designed our loans for customer success, meaning our most profitable loan is the one that is paid back on time and in full. This makes the incentives of our business align with our customer success with our loans. As a mission-driven lender working to bring financial inclusion and brighter economic opportunities to our customers, we want to thank Financial Health Network for working with us on this study and helping to demonstrate to consumers and other stakeholders that Opportune loans are affordable, responsible, and accessible options for the estimated 100 million US consumers who've either been excluded from financial mainstream simply because they do not have a credit score or because they have been misscored. We are committed to our mission of helping our customers obtain affordable credit to meet their needs today and help create a better tomorrow.